Welcome back to the deep dive. We take the sources you share with us and really drill down to get those essential insights. We want to help you cut through the noise, get well informed fast.
Exactly. And if you're curious about how this all works, or maybe you have a ticker you'd like us to prioritize for a future deep dive.
Oh yeah, check out Stock Analytics AI. It's what, Euro 4.99 a month. Gives you some members-only perks like getting your suggestion moved up the list.
That's right. Think of us as your guides through the info you give us. We highlight what's important, why it matters. Give just enough context so it sticks. Hopefully spark a few aha moments.
And today, we are plunging headfirst into, well, a really interesting space, industrial automation and machine vision. We're looking specifically at Cognex Corporation, ticker is CGNX.
Right, CGNX. You've given us a pretty deep analysis piece on them, dated May 22, 2025.
Yeah, it's comprehensive. So our mission today, let's unpack this source material, figure out what Cognex is all about, check its health, the leadership, its outlook.
And crucially, understand the why behind that hold recommendation in the analysis. It looks at a company really on the cutting edge, helping machines, well, see.
It covers everything, doesn't it? Business, markets, financials, management, market view.
The works. We'll lay it all out. And remember, all the sources we're digging into today are linked right there in the description.
Okay, then, let's unpack this. So, jumping right in. The basics. What exactly does Cognex do?
Okay, fundamentally, Cognex is a premier global provider of machine vision systems. Think of them as giving machines their eyes.
Eyes for industry.
Exactly. They provide specialized software, sensors, full systems, and also industrial barcode readers, all designed to let automation equipment handle complex visual tasks.
Right, and this isn't just, tech for tech's sake. This stuff is crucial for automating tasks in manufacturing, logistics, spotting tiny defects, identifying parts.
Guiding robots, ensuring quality.
Right.
It's fundamental stuff for modern production and warehousing.
Okay, and the market they're in, industrial automation, machine vision, it's growing fast.
Oh yeah, incredibly dynamic and rapidly growing. Several big trends are fueling this.
Like the constant push for better quality and efficiency.
Definitely. Consumers and businesses just expect fewer errors. Plus, you have the whole Industry 4.0 thing, smart factories, connectivity.
That's huge.
It is. And then there's the practical side. Labor shortages in many places. Automation becomes less of a choice, more of a necessity.
So analysts are pretty bullish on this sector's growth.
They are. Projections point to really robust compound annual growth rates, CGRs. Estimates vary a bit naturally, but range from around 8.7% up to maybe 13.9% per year for the coming years.
Wow, nearly 14% at the high end. That's significant expansion.
It points to a strong, expanding market, not stagnant at all.
And the tech itself is evolving rapidly too, I assume.
Absolutely. It's being reshaped by things like AI for really sophisticated image recognition, 3D vision for depth perception, powerful smart cameras that process data right on the device.
And Cognex is right in the thick of this, pushing AI and deep learning hard.
That's their core strategy, yes. They're embedding AI and deep learning capabilities directly into their products. The source mentions things like their Insight D900 vision system, their Vision Pro deep learning software.
So they want to be the leader in AI for this industrial vision space.
That seems to be the goal, positioning themselves at the forefront.
Okay, so how do they actually, operate as a business? What's the model?
Well, they design, develop, and market their products. The actual manufacturing, though, that's mostly outsourced to third parties.
Okay.
And the value proposition for customers is pretty clear. Improve quality, cut errors and costs, boost efficiency. Their systems often pay for themselves pretty quickly through better yields and less waste. A strong ROI.
Can you give us a feel for their main product lines?
Sure. They've got the well-known Insight family of vision systems, including that AI-powered D900 we mentioned. Then there's the software side Vision Pro Deep Learning for setting up and running these tasks.
And barcode reader.
Yep, the DataMan series. And these aren't just basic scanners. They have AI-powered versions now that can read really tough codes, damaged, poorly printed, you name it. Plus, 3D vision systems, like the Insight L38 that combines AI, 2D, and 3D imaging. And the key theme is that AI and deep learning thread running through the whole portfolio, trying to make complex tasks easier for users.
Got it. Now, revenue mix. The source mentioned 2023 figures, mostly hardware.
Primarily, yes. Hardware sales were around $654 million in 2023, but software licensing and subscriptions added a decent chunk too, about $173 million. So there's a software element, providing some recurring revenue.
And their customers are pretty diverse, different industries.
Very diverse, which is good. Generally helps smooth things out, though some sectors are definitely more cyclical.
Right.
Based on 2024 revenue,
Mhm.
logistics was big, about 23%, and growing strongly, up 20% year over year.
Okay.
Automotive was around 22%, but that one was tricky. It saw a 12% decline year over year. Yeah. Consumer electronics, about 17% modest growth, and semiconductor was 11%, but that jumped a huge 80% year over year, partly thanks to an acquisition.
Right, the Moratex deal.
Exactly. So logistics, auto, and consumer electronics made up roughly 60% of their 2024 revenue.
And they started breaking out semiconductor and packaging more specifically in Q1 25.
Yes, which kind of underlines the growing importance of those markets. Packaging covers things like fast-moving consumer goods, healthcare, areas needing automation.
And they operate globally.
Oh, absolutely. Americas, Europe, Greater China, other Asia. Performance varies by region, of course. Americas grew in 2024, driven by logistics. Europe dipped slightly logistics growth, offset by auto and factory automation weakness.
Mhm.
Greater China was flat overall. Acquisition benefits and strength in semi were balanced out by declines in factory automation. Other Asia saw really strong growth, up almost 50%, driven by Moratex, semi, and logistics.
So that global spread helps, but exposure to cyclical markets like auto and consumer electronics still introduces volatility.
Definitely. It adds risk. But right now, the strong growth drivers seem to be logistics and semiconductor, helped significantly by moves like acquiring Moratex, which boosted their Asia and semi footprint.
Okay, so where does Cognex actually stand in this whole market? Are they considered a leader?
Consistently, yes.
Yeah.
The sources call them a leading global provider, even the world's leader, since way back in '81. They've shipped over 4.5 million products, cumulative revenue over $11 billion, market cap currently around $5.2 billion.
So a long track record.
Huge installed base, strong brand recognition, deep expertise, those are real advantages.
But who are they up against? The competition.
It's definitely a crowded field. You've got major players like Keyence, known for their sales model and wide range of products. Omron, another big automation name, Basler in cameras. Teledyne has vision components.
Software specialist, too.
Yeah, MVTech is one, SICK AG in sensors and vision. And then you have niche players, and increasingly, AI startups jumping in names like Faro, MechMind, Deepak. It's competitive.
So how does Cognex stand out from that crowd? What's their edge?
Several things highlighted. Their advanced tech, especially that deep learning and AI focus, a broad portfolio, the strong brand we mentioned, global network.
And patents.
Crucially, yes, a huge patent portfolio over 1,700 globally, more than 1,100 active. These protect key innovations like their PatMax pattern matching tech and their newer AI stuff. That's a serious barrier for competitors trying to copy them.
Makes sense.
And that strategic focus on AI aims to make complex tasks easier for customers, which is a big differentiator in this market.
How hard is it for someone new to break into this space? What are the barriers to entry?
They're pretty high. You need massive R&D investment, especially for cutting-edge AI and optics. Significant capital, even with outsourced manufacturing. Established players have economies of scale in R&D, production, sales.
And customers might be reluctant to switch.
Exactly. Strong brand loyalty exists, and switching costs are substantial. Integrating these systems is complex, requires validation. Engineers need training on specific software like Vision Pro. Ripping out an installed system isn't easy or cheap.
Plus, finding the right talent must be tough.
Yeah, the shortage of skilled AI and machine vision engineers is a hurdle for everyone in the industry, maybe even more so for newcomers.
So, summing that up, their economic moat, their sustainable advantage, what creates it?
The source points to a few key pillars. Brand strength and reputation, built over decades. That proprietary tech and patent protection, especially around AI. Customer relationships and those high switching costs we talked about.
Network effects, too.
Indirect ones, yeah. A large installed base means more engineers are familiar with their systems, plus a well-developed partner network. And finally, economies of scale spreading R&D and operational costs over a large revenue base.
And Morningstar calls it a narrow moat.
Right. It's a solid advantage, but the analysis notes it requires constant innovation and execution to maintain, especially with fierce competition and the pace of AI change. And those cyclical markets add pressure.
Okay, let's pivot from the what to the who. Management. There's a big change coming up, right?
That's correct. Robert J. Willett, the CEO since 2011, is retiring effective June 27, 2025.
And he had a good run.
A very strong run.
Right.
Revenue grew five-fold under his leadership, past $900 million. He oversaw key moves like pushing AI deeper into products, Salesforce changes, integrating that big Moritex acquisition.
And it sounds like a planned transition.
Yes, the source indicates it's a well-planned, multi-year succession.
Yeah.
He's staying on the board and as an advisor, so there's continuity.
And the new CEO is an internal promotion.
Yes. Matthew Moschner takes over on June 27th. He's currently president and COO, joined back in 2017. He's led key areas like ID products, handled the Moritex integration, which was seen as successful, and dealt with supply chain issues.
So he knows the business well.
Seems so. Plus, he has a strategic background from BCG Consulting and experience at Boeing. An internal pick often suggests strategic continuity.
And he's already laying out a vision.
He is. There's a new 5-year strategic plan, and we'll get the details at their Investor Day on June 10th, 2025. But the source highlights 3 key goals already announced. Be the #1 AI provider in industrial machine vision, deliver the best customer experience, and significantly grow the customer base.
Who else is on the leadership team?
The source mentions Dennis Fair as CFO, noted as an active communicator. Sheila DePalma, EVP of Employee Services and Chief Compliance Officer, has been there a while. And Georg Kuchin is the CTO, driving innovation. Average management tenure is around 6 years, suggesting some stability.
How do they approach capital allocation using the company's cash?
It looks like a balanced approach, investing in organic growth R&D mainly, strategic M&A, and returning cash to shareholders through dividends and buybacks, generally seen as a prudent strategy.
That R&D spend seems critical given their tech focus.
Absolutely essential. They invest heavily and consistently. Almost $140 million in both 2023 and 2024. That's 15–17% of revenue. Q1 2025 was over 16%. You need that level of investment to lead in AI.
M&A is part of the plan, too.
Yes. They do smaller tech tuck-ins, and then the big one was Moritex in late 2023 for about $270 million. That added optical components, boosted their Japan and semiconductor presence. Moschner led the integration, and it was reportedly successful, accretive to adjusted EPS, added about 8% to 2024 revenue. Management says they want to keep M&A firepower.
And share buybacks.
They're active there, too. A $500 million program started in March 2022. They bought back $67 million in 2024, and then a big $102 million chunk in Q1 2025. The source called that Q1 buyback opportunistic, suggesting management saw value in the shares then. They still had around $266 million left on the authorization end of 2024.
Dividends as well.
Yep, a quarterly cash dividend. Good track record, 11 straight years of growth, currently $0.08 per quarter. So $0.32 annually. They just raised it in Q4 2024. Growth has averaged around 7–8% recently, and the payout ratio is sustainable, around 45%.
And they seem focused on free cash flow.
Very much so, and managing working capital effectively. We should hear more about their financial framework under the new strategy at the Juneteenth Investor Day.
What about governance and IP protection?
Standard stuff on governance, it seems. Independent board mostly, separate chair CEO roles, code of conduct. They use IR for disclosure. On IP, they have a history of strongly defending their patents, fighting patent trolling in the past. Shows a culture that values innovation.
Let's touch on ownership again. The founder, Dr. Shulman, still a major holder.
He's historically been a very significant holder, often over 5%. While exact current numbers vary, he's believed to still hold a substantial position.
And recent insider trading.
A bit of a mixed bag. Some selling noted by executives like the CTO and an EVP in late 24, early 25.
Right.
But also buys by the CFO and a director late 24.
And the incoming CEO.
Right. Matthew Moschner got a large option grant over 279,000 shares, exercise price $27.99 on May 7th, 2025, tied to his promotion. That's a significant alignment signal. So while net activity tilted slightly sell recently, the CEO grant is noteworthy.
And institutional ownership is very high.
Extremely high. Sources say 80–95%. Big funds like Vanguard, BlackRock, T. Rowe Price hold large stakes, maybe 5% to over 10% each. Top 25 holders own around 63%.
Which means big fund moves can really impact the stock price.
Definitely. The source mentioned Capital Research and Fundsmith exiting large positions late last year, which likely contributed to pressure on the stock then. High concentration means you need to be aware of potential fund flows.
Okay, let's dive into the numbers. Financial health. How's the historical track record?
Well, looking back 5–10 years, revenue shows growth, but it's definitely cyclical. The trailing 12 months, or TTM, revenue as of March 2025 was around $920 million. That's up about 8.5% year over year.
Showing a recovery.
Yeah, 2024 revenue was $915 million, up over 9%, recovering from a dip in 2023, $838 TEM, and 2022, $1.006 B, after a high in 2021, $0.037 B. So they hit a peak, came down, and now seem to be climbing back, helped by logistics, semi, and that Moratex deal.
Q1 2025 continued that trend.
Q1 revenue was $216 million, up 2% year over year, or 5% in constant currency. So modest growth continued.
What about the bottom line? Net income, EPS.
Even more volatile than revenue, as you'd expect. 2024 net income was 106 embers, ETS 62 cents, actually down a bit from sort of 65 in 2023, despite higher revenue. TTM EPS as of May 2025 was 69 cents. Q1 2025 adjusted EPS came in at 16 cents, which beat analyst estimates.
Profitability, gross margins, still strong.
Historically very strong, yes, but they've been under some pressure lately. Adjusted gross margin in Q1 2025 was 67.6%. That's down from 69.3% for full year 2024.
Why the pressure?
The source points to a few things. The Moratex acquisition diluting margins a bit initially, an unfavorable product and geographic mix, and there'll be some pricing pressure in the market.
Okay, operating margins.
Those have actually improved recently, which is good. Q1 2025 adjusted operating margin was 14.4%, up significantly from 9.4% in Q1 2024. That's attributed to good cost management. TDM operating margins around 13.8%.
Now, the balance sheet, you said that's a strength.
A major strength. The source really emphasizes this. As of March 30, 2025, total assets around $1.93 billion, equity $1.45 billion. Very solid footing.
In cash.
Lots of it. $513 million in cash and investments as of March 30, 2025. Down a bit from year-end 2024, likely due to that big Q1 share buyback.
And the crucial point, no financial debt.
That's huge. Zero traditional interest-bearing debt. Some data might show total debt, including operating leases, but fundamentally they have no bank loans or bonds. Massive financial flexibility for R&D, M&A, returns, weathering downturns. It's a big advantage.
Liquidity looks good too. Current ratio, quick ratio.
Yep, robust.
Yeah.
Current ratio around 3.1 to 3.6 in Q1, quick ratio around 2.0 to 2.3. Healthy liquidity means they can easily cover short-term obligations.
How about cash flow generation?
Strong. TTM operating cash flow was almost $176 million. Q1 2025 was $41 million, up nearly 200% year over year. CapEx is pretty modest, only $2.05 in Q1, $59 for all of 2024.
So free cash flow FCF must be strong too.
Very strong. TTM SDF was about $162 million. Q1 FCF was $38 million, up almost 300% year over year. 2024 FCF was $134 million.
And they convert earnings to cash well.
Extremely well. That Q1 FCF conversion rate was 140% of adjusted net income. That's a great sign of earnings quality. This robust FCF allows them to fund R&D, M&A, dividends, buybacks, all internally.
Okay, but now we hit that point. The source flags as a major concern. Capital efficiency, return on invested capital, ROIC.
Right, this is critical. ROIC tells you how well a company is using its invested capital, both debt and equity, to generate profit. And the source shows Cognex's ROIC has been falling from strong levels back in 2021.
How low has it gotten recently?
TTM ROIC as of May 2025 was reported around 5.14%. Full year 2024 figures were in the 4.5% to 5.7% range, depending on the source.
And you compare that to their WAC's, weighted average cost of capital.
Exactly. WACC is the company's cost of funding itself, what return investors expect. The source estimated Cognex's WACC at 12.73% as of April 2025.
So wait, recent ROIC is around 5-6%, but their cost of capital is over 12%.
That's the problem, precisely. When ROIC is consistently below WACC, it means the returns generated aren't covering the cost of the capital used to achieve them. It raises serious questions about whether growth is actually creating shareholder value.
If this continues, growth could even destroy value.
In theory, yes. It's a major red flag for value investors. Now, the source did note one outlier report putting Q1 2025 ROIC much higher at 12.3%.
Closer to WACC.
Right. If that represents a sustainable turnaround, it's positive. But based on the broader trend shown in the TTM and annual data, the recent picture has been ROIC significantly lagging WACC. This needs close monitoring. It suggests challenges turning investments into proportional profits.
Okay, let's shift to market sentiment. What's the market telling us? Stock price around $30.98 as of May 22nd.
Right. And importantly, that's way down from the 52-week high of nearly $53 back in July 2024.
A big drop. Suggests the market has priced in some bad news.
Definitely seems like it. The automotive slowdown, macro uncertainty, maybe worries about tariffs impacting customer spending, a lot of that seems baked into the current price, which, could mean a value opportunity if things turn around.
How does the valuation look at this $31 price? Market cap around $5.2 billion. PE.
Price to earnings, based on that 69 TTM EPS, is around 44.9.
45 times earnings sounds high, is it?
Well, yes, on an absolute basis,
Yeah.
and it's higher than some industry peers trading maybe 21-30 times earnings. But interestingly, it's below Cognex's own historical averages. Their 10-year mean PE was closer to 48, and the 5-year average was way up around 57.
So still a premium, but less of a premium than it used to command.
Exactly. The market still seems to be giving them credit for their tech leadership and growth potential, but maybe with more caution than before.
Other metrics, price to book, price to sales.
Similar story. PD around 3.6 versus historical 6.7. PS around 5.65 versus historical 7.9. EV/EBITDA around 31.5, higher than peers typically in the 15-25 range.
So the takeaway on valuation is premium to peers, justified by their position, but below their own historical highs. And it's a demanding premium that needs strong execution and improved capital efficiency.
That nails it. The valuation requires them to deliver.
The source also mentioned a DCF model, discounted cash flow.
Yeah, conceptual framework. Project future free cash flows. Apply growth rates, maybe aggressive short-term like 10-15%, then settling down long-term and discount it all back, using that WACC of 12.73%.
And what fair value range did that analysis suggest?
The estimate was $35 to $42 per share.
Compared to the current price, around $31.
Right. So based on this specific DCF, the current price is trading below the low end of the estimated range, suggests a potential margin of safety.
But big caveat, tied to that ROIC problem again.
Huge caveat. Realizing that upside depends entirely on execution and improving returns. For the DCF to work out favorably, FCF needs to grow substantially, and that growth needs to be value-creating, meaning ROIC must get sustainably above WACC. If ROIC stays low, growth doesn't help the valuation much, maybe even hurts it.
How are analysts feeling? Mixed bag.
Very mixed. Aggregate ratings differ, but one source broke it down, maybe 35% strong buy, 15% buy, 38% hold, and around 14% sell. So opinions are clearly divided.
Average price targets suggest upside, though.
On average, yes. Targets range from about $38.70 up to nearly $50 across different sources. That implies potential upside of 25-30% plus from the current price.
But the range of targets is huge, $26 to $56.
Extremely wide. That tells you there's a lot of uncertainty among analysts about the recovery timing, strategy execution, macro impacts, reflects the conflicting signals. Some had trimmed targets recently, too.
Any other sentiment indicators? Short interest options?
Short interest was moderate mid-March, around 4.9 M shares, about 2.2 days to cover. Not extreme bearishness. Options activity for May expiry showed a low put-call ratio, 0.21, generally bullish, suggesting more bets on upside than downside for that specific time frame.
Let's quickly revisit ownership. We mentioned the founder, Dr. Shillman, still significant.
Believed to be, yes. Historically a major holder, though exact current figures vary.
And the insider activity leaning sell recently, but with the new CEO's option grant being key.
Exactly. Some executive selling, but balanced by CFO director buys. And that big option grant from Moschner. Worth watching the overall pattern.
And the very high institutional ownership.
Right, 80-95%. Concentration among big funds like Vanguard, BlackRock, T. Rowe Price means their decisions can really swing the stock, like when Capital Research and Fundsmith reportedly sold large stakes last year.
Okay, time to synthesize. The SWOT analysis from the source, strengths, weaknesses, opportunities, threats. Let's build the bull case first. Strengths and opportunities.
The strengths. Clear market leader, strong brand, huge patent portfolio protecting their tech, especially AI. Financially rock solid, no debt, lots of cash, strong FCF. Diverse end markets with current high growth in logistics and semi. Experienced management, seemingly smooth CEO transition plan.
And opportunity.
The biggest is the massive, growing industrial automation market itself. Industry 4.0, labor shortages, quality demands driving it. Cognex is plugged into high-growth segments like e-commerce logistics and AI chip-related semiconductor manufacturing. Their new AI products open doors to more complex, higher-value applications. Internal efforts to expand customer reach, longer-term supply chain shifts reshoring could be a huge tailwind, and a recovery in automotive EV manufacturing automation. Lots of potential growth drivers.
Okay, now the bear case. Weaknesses and threats.
Weaknesses. Significant exposure to cyclical industries like auto and consumer electronics introduces volatility. And the big one, financially. That ROIC falling below WACC recently. If that persists, growth isn't creating value. That's a major concern. Gross margins have also faced some pressure.
And external threats.
Continued downturns in key markets. Intense competition from big players and nimble AI startups leading to potential price pressure. The constant need for massive R&D investment in AI and the risk of falling behind. execution risk with the new CEO and strategy, negative currency moves. The indirect impact of U.S. tariffs potentially delaying customer spending is a big one highlighted.
Insider selling pattern worth noting.
Yes, while possibly benign, it's something bears might point to. And finally, the industry-wide challenge of attracting and retaining scarce AI vision talent.
So pulling it all together, Cognex, a tech leader, growing market, strong financials.
Absolutely. But also facing real near-term headwinds, cyclical markets, macro uncertainty, potential tariff impacts.
And critically, that ROIC versus WACC trend is a major point investors need to focus on.
Yes. Now, at the current price, around $31, the stock has pulled back a lot. The analysis suggests it's trading below a conservatively estimated fair value range, $35, $42, potentially offering a margin of safety if they execute and markets cooperate. A lot seems priced in.
So the overall stance from the source.
It leans towards potentially favorable for patient, long-term investors who can stomach the near-term bumps. The reward potential is there if automation grows, the AI strategy works, and markets recover.
But the risks are significant.
Very real. Macro, cycles, competition, execution risk, and that need to improve capital efficiency. The success of the new CEO and strategy in driving growth and improving ROIC is paramount.
Which leads to the source's final recommendation, hold E for CGNX at the current price.
That's the takeaway. The fundamental strengths are clear, but the uncertainties and the need for better capital returns mean it's more of a watch-and-wait situation than a time for aggressive buying, according to this analysis.
So what should you, the listener, be watching?
Execution of the new strategic plan, especially hitting those AI leadership and customer expansion goals. Signs of recovery in automotive spending. The actual impact of tariffs on customer decisions. And most importantly, watch that ROIC. Look for a sustained improvement, hopefully getting it back above WACC.
And a key date is coming up.
June 10th, 2025, the Investor Day. That's when we'll get the detailed strategic plan. Crucial for assessing their roadmap.
All right. We've covered the tech, the markets, the financials, the risks, the valuation, and the hold rationale. It's a complex picture. So here's that final provocative thought for you to mull over. Given this tension, Cognex as an AI leader versus its recent returns on capital falling below the cost of capital, how absolutely critical is it that the new strategic plan unveiled on June 10th specifically addresses improving capital efficiency? And what will the details signal about their ability to finally translate all that impressive tech innovation into tangible, value-creating returns for shareholders down the road?
That was our deep dive into the source material you provided on Cognex Corporation, CGNX.
Yeah, it's really something watching a company working with cutting-edge AI navigate these very real, very challenging economic crosscurrents.
We certainly hope this exploration gave you some valuable insight, things to chew on.
And remember, this deep dive is based entirely on the information in the source material you shared. Before we sign off, the standard research and AI disclaimer from the source appendix.
Standard disclaimer from source appendix. This report is for informational purposes only and does not constitute investment advice or recommendation to buy or sell any security. All investment decisions should be made with the consultation of a qualified financial advisor, considering your individual financial circumstances and risk tolerance. The information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is not indicative of future results. The stock market is inherently risky, and principal loss is possible. All opinions expressed are subject to change without notice.
If you got sources you want us to dig into, let us know. And hey, if you want more from Stock Analytics AI, definitely subscribe to their YouTube channel.
Until the next deep dive.